Hey everyone, Coach Investor back to another video for today. So in today's video, I want to present to you 2 stocks to buy, 1 stock to sell. 3 fresh companies that have never been featured on this channel before. One of the 3 was actually one of my viewers during a live stream that mentioned this company. So I looked into it and I was like, okay, worthy of a mention. Now, of course, there are plenty of other companies to buy right now, plenty of other companies to sell as well. But let's keep it simple, 2 buys, 1 sell. First company I want to touch on is Dutch Bros. If you're in the United States, you're probably familiar with this company. Yes, it's a company that has plenty of competition, right? With the likes of Starbucks and every other coffee shop around. But let's have a look at how the company is doing, what the market is expecting, and then we'll move on from that. If you enjoy this type of videos, leave it a thumbs up, subscribe if not. We'll really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, Dutch Bros. Market cap $5.56 billion, has a forward PE of 88.9 times. Now, of course, it is very high. But as you can see, the analysts expect the bottom line to increase quite fast while increasing the top line quite fast as well for fiscal year 2023, which of course we're going to get the Q4 numbers in the weeks ahead. So fiscal year 2023, sales growth of 30% with EPS growing 72.6%. In fiscal year 2024, sales growth of another 25.6% and EPS growth close to 30%. Fiscal year 2025, another 23% year-over-year growth for sales and another 30% growth for EPS. So definitely this is a fast growing company. Now if we look at the average analyst price target, sits at $33.5, which represents close to 8% upside from the price we're at today. If we look at forward PE, EV to EBITDA price to sales, we can see that right now the stock is trading at a cheaper multiple. Now, since a year ago, the stock has gone up around 13%, so not that much. But as you can see, the business itself has been performing quite well, top and bottom line. If we have a look at their Q3 presentation, we can see that shops has increased 24% year over year. There are, of course, franchised ones and company operated, a bit like the McDonald's model, for example. Then with regards to revenue, that has increased 33% year over year. Company operated shop contribution margin is now at 31% compared to 25.6% same quarter last year. And net income and adjusted EBITDA, we can see adjusted EBITDA increased 91% year over year with an adjusted EBITDA margin of 20%. Net income went from $2 million to $13 million. Now here we can see the improvements from a company operated shop margin progression. First quarter it opens, it's a loss of 29%, but as you go further, second quarter you're already in a positive 18%, third quarter 23%, fourth quarter 26%. Now, how did the company operated shop contribution go up from 25.6% to 31%? Well, the big push here was from an increase here in menu prices that has increased that by 4.1%. The rest, 0.5% from discounts, 0.8% from pre-opening cost, labor cost 0.6%, and then leverage 0.4%. The hits came from ingredient costs, shop operating expenses, and others. As for the outlook for fiscal year 2023, they expect at least 150 total system new shops opening, at least 130 company operated shop openings, revenue lower end of the range $950 to $1 billion, same shop sales growth of approximately low single digits, adjusted EBITDA between $150 and $155 million, and capex between $225 to $250 million. So as you can see, the growth story is alive and well. Fundamentally, financially, the company is doing all the right things. There are, of course, some risk, increased competitions. You also have to find the right person to manage those stores. It's very important for the business itself, but also for the culture of Dutch Bros. It has a very different culture than other competitors out there, so you really need to find the right employees, the right managers to operate those stores. If that doesn't work anymore in the future, then yes, they should be taking a hit. Now, with regards to the stock, of course, over the last year or more, the stock has gone down more and more. You can see here lower lows throughout 2023 and at the end of 2022 as well. But it does seem like we have bottomed in October of 2023 at $23. We're now sitting at $30, which is above the 20, the 50, and the 200-day moving averages. Previously, we were rejected at around $35 or so. So let's see if we can stay above that 200-day moving average, which sits around $30. So we're in that range. Up next, company number 2 is the company that my viewer suggested to look into, and that's Cooper Standard Holdings. Now, for those of you that don't know what they do, well, it's a leading global supplier of systems and components for sealing and fluid handling solutions, supporting diverse transportation and industrial markets. Of course, the automotive industry, a big deal for them. So right now it has a market cap of just under $300 million. Last year, the stock went up 66.8%. But as you can see right here, it is very, very strange to see EV to sales multiple of 0.5 times. Because look at this, market cap close to $300 million. Now, the analyst expectations, of course, not a lot of analysts are actually covering this company, but still, sales for fiscal year 2023, sales is expected to be $2.83 billion. $2.83 billion in sales, while market cap only $300 million. Pretty incredible. EPS, of course, still very negative here, but you can see year-over-year improvements for fiscal year 2023 to 2024. You go from a loss of 3.80 cents to a loss of 0.94 cents. Quite an improvement. Now I'll just show you the average price target, even though there is just one analyst covering this, and the average price target sits 25.7% higher than the price we're at today, which sits at $22. Now I do want to show you one extra thing here from the cash flow statement. This is the consensus number. Again, we don't really have that much to base ourselves on, but still, cash from operations, yes, it was negative from 2020 to 2022. Automotive industry didn't do that well, supply chain issues, etc., which is also why the stock dropped a lot. But calendar year 2023, $107 million, and then calendar year 2024, expectations of cash from operations of $185 million. Then if we go and look at their latest earnings report, which was Q3, so sales of $736 million, gross profit of $106.5 million with a margin of 14.5%. Again, big improvement from the same quarter last year, which was just 5.9%. Adjusted EBITDA increased from $20.5 million to $79.1. Margins here basically tripled, more than tripled. If we look at net income, went from negative $32.7 million to net income of $11.4 million, so EPS fully diluted, 65 cents compared to a loss of $1.90. Now for them to increase revenue, of course, they can increase efficiency, product mix, stuff like that. So in this slide, they show us one of the ways to increase CPV opportunity, which CPV stands for content per vehicle. Of course, the more they can sell to a car maker, the better. Here they're talking about this opportunity right here with regards to integrated fluid system. They think they can increase that by 60% incremental FTS CPV, which was content per vehicle growth opportunity. As for the guidance, and this takes into consideration the UAW strike, the effect of that. So right now, the current 2023 guidance, sales expectations between $2.7 to $2.8 billion, adjusted EBITDA $165 to $180 million, which as you can see is higher than their previous guidance. CapEx stays the same, cash restructuring bit lower, $15 to $20 million. Cash interest stays the same here, net cash taxes is lower as well. With regards to light vehicle production, this is in million units. So in North America, 15.2 million, Europe 17.7 million, Greater China 27.9, and South America 2.9 million. Now, one of the key drivers here, which we've also seen already in Q3, so they say here global oil production cuts, tight labor availability in certain markets, and geopolitical uncertainties are still risks. But moderating inflationary pressures and stable consumer demand is what has pushed already better results right now. Then if we look at the graph here, it is pretty clear that since August 2022, this stock has done higher lows. Right now we're sitting at the 50-day moving average, $17.28, 200-day moving average sits at $15. It does seem like $21, $22 is a bit of a resistance point. but RSI has gone back down to around 53, so we're pretty neutral. Now, of course, Cooper Standard might not be your famous fancy schmancy stock that gets talked about on Yahoo Finance or any other platform, but I was very, very happy to hear about this company from one of my viewers because, well, these are the types of interesting companies that I would like to cover more and more, especially in 2024. A company that goes under the radar, that is pretty strong, pretty stable, and an important part, especially in the automotive industry. Now, of course, if 2024 will be a weak year for the automotive sector, another weakish year for the automotive sector, then yes, maybe this company might take a hit. But seeing at how cheap it is right now, $300 million in market cap, while generating $2.7, $2.8 billion in revenue, might be worth your while. Now, company number 3, and that's the one company to sell in this video, that's Plug Power. Hydrogen. Hydrogen has been hyped up, in my opinion, a bit too much in the last couple of years. This is one of the companies that deals with that. We've obviously heard about Amazon that steps into green energy, pioneering hydrogen fuel production for a sustainable future. In my opinion, hydrogen, there are better alternatives out there. But anyways, Plug Power has a market cap of $2.66 billion. Last year, the stock crashed another 66.15%. Now here, if we look at the analyst expectations, you can see that sales growth will increase quite a lot in the next fiscal years. I mean, we go from just over $1 billion in sales in fiscal year 2023 to $2.5 billion in fiscal year 2025, but we're still remaining here unprofitable. And then being unprofitable, cash burn company is not great, especially not when you're running out of cash pretty soon, which I'll show you in just a bit. With regards to the average price target, there are 29 analysts covering this company, and the average price target sits at $8.24, representing 88% upside. Now, as you can see, it has been pretty clear that the average price target has come down quite a lot over the last year or two. Now, the issue with Plug is not that they can increase revenues. No, that has not been an issue actually for a while. The issue here is that all the rest goes into the wrong direction. Free cash flow, negative, increasing. Gross profit margin, worse over time as well. And for a company that doesn't really have that much cash left to survive, that is really not painting a pretty picture. I mean, they will be running out of cash pretty soon. Now, in their latest report, they did talk about this step right here, future funding roadmaps. So 1, corporate debt solutions, US Department of Energy loan program, and 3, project finance and plant equity partners. There are, of course, many other ways to raise money. You will probably dilute shareholders, but you will need to find those ways. You will need to find partners to give you loan, seeing how weak your balance sheet actually is. Who will take that risk? Now, I don't think we're going to see them file for bankruptcy anytime soon. But if you look at their balance sheet, how much cash they're burning, how much cash they have left, I mean, I give them a quarter or two before they run out of cash, unless they somehow raise money. I mean, they themselves said here, 2023 overall financial performance has been negatively impacted by unprecedented supply challenges in the hydrogen network in North America. We believe this hydrogen supply challenge is a transitory issue, especially as we expect our Georgia and Tennessee facilities to produce at full capacity by year end. Now, of course, when you read this, if this was a financially stable company, you would say, okay, they have time. But this is a company that is running out of time. This is a company that is running out of money. And if we look at the graph, I had to zoom out quite a lot. So we're basically now back to where we were back in June of 2020. I mean, this stock did fly extremely high in 2021, even at the start of 2022. But right now we are around $4.40, right at the 20-day moving average. The 200-day moving average sits at $8.42. RSI is pretty low, but not oversold. So with regards to Plug, it's pretty simple. Find a way to increase your cash, because otherwise you're going to run out of it sooner rather than later. So that will be it for this video. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.